Hi everyone. We are live on YouTube also, so we can start. Uh, Hi everyone. I'm excited to welcome you to our investment awareness webinar in the collaboration of with NEC. I'm Rakhi from Team Dhan. I'll be your host today, and we are going to explore the
Hi
investment
everyone,
world.
we are live on YouTube also, so we can start.
Hello, am I audible? Okay, okay. I think we can start. Just a note, please be aware that this webinar is dedicated only exclusive for investment awareness. Will not be discussing specific stock, making recommendation or offering any tips during the session. We'll also have a Q&A session at the end of webinar. You can post your questions in our chat box Q&A and we'll assist them during after the webinar. I think we can start. We have Gaurav is a chief minister with NSE. He has a vast experience with 14 years experience in capital market. He has been associated with NSE since 2009 and he has current role to empower investment through education and awareness, enabling them to control to their financial futures and contributed to the growth of economy. Gaurav will present the screen. Over to you, Gaurav.
Yeah, thank you so much. I think am I audible?
Yes, yes.
Okay, great. So let me share my screen. I hope my screen is visible
Yes.
and on full screen mode.
Yeah.
Okay, great. So welcome all of you all to this session. And so as you can see on your starting, the session is called Pratham. Pratham is the start. So this is level 1 of our financial literacy program. And going forward, we also will have it goes into much into securities market and slightly more detailed as well. So we have multiple levels. So this is the first level. So we start off with some basics on financial planning before we move forward. So this is just the disclaimer. Okay, so first and foremost, let's discuss who is this module for? Who should go through this module? Now, if you see on your screens, you have a person called Pratham. We've named him Pratham. Pratham is a start. So Pratham at the moment is about 32 years of age. He is married and both of them are working for public sector companies. And they have some surplus funds available in their savings account, but they have not started investing. So this is Pratham, who is new to investing. He wants to know a little bit about the capital markets, and his target is to deploy money decisively so that he can get some decent returns from the market. So, so the agenda will be as follows. First is where we'll understand what is more important. Is it savings or investment or both? Then what are the steps in financial planning? Then we'll move forward to what are some of the investment sutras that one can adopt. And we'll touch a little bit upon what is capital markets and a little bit on mutual funds. And we'll end with some ETFs, which is exchange traded funds, and SGBs, which is sovereign gold bonds, right? So we'll start with this. So first and foremost, money. So what is money? Money is something that doesn't buy you happiness automatically. What money buys is money buys choices. So what you do with these choices will determine whether you're going to remain happy or not. So if you eventually buy things that you do not need, soon there will be a time where you have to sell things that you need, right? To avoid that situation, it is very important for us to manage money, right? So what is more important? Is it savings? Is it investment? So if you see, definitely, as we all know, investment is very important. But until and unless we don't save money, we will not be able to invest. Hence, both are important. First, we need to save money and also regularly invest, right? So by investing a very small portion of your income, so you allow your money to work for you, right? So we work very hard day and night, and we do not generally. We have seen that the money also needs to work, right? So we work and we also need to put our money work for us, right? So how can we do that? We can do it by investing in various asset classes, right? So some groups we have mentioned, they can be equities, mutual funds, bonds, futures and options. There are many options, right? Where one can invest in. So to start with, we'll have to start with something called as financial planning. We need to plan first. First is the planning stage. So what is planning? Planning is bringing your future to the present so that you can do something about it at the moment. And how would you go ahead and do the financial planning? So first and foremost, on the right side, if you can see, is you need to identify your goals. So goals could be different for different people, right? Somebody who's very young, just in his college, his goal could be just about buying a two-wheeler, right? For somebody, it can be buying a car. For somebody who's married, it can be providing good education and other expenses for family. So we need to identify what your goals are, right? So once you identify these are the goals that I need to these are my goals, then you need to identify the assets. What are the assets at the moment you have, and what are the liabilities at the moment you have? So it's like a balance sheet. These are my assets. One side you have assets, on other sides you will have your liability, right? Then we need to understand going forward, as you know, there's inflation there, so we need to understand that going forward, what are going to be my likely future earnings. Somebody who's salaried person, somebody who's getting into business, we'll understand what your future earnings would be or can be, and then what your future likely expenses are. Correct? And then once we have an idea of all of these things, then we need to make a plan to invest. And we need to invest in places where you get returns as per what our plan is, right? And then the next step is to review those goals. So review your investment patterns wherever you have invested. So when you have to review, you'll have to go through the cycle again, right? If you've identified some goals, some goals have changed, some assets or liabilities have changed, some future expenses may have changed, right? So you need to do that. And also even in terms of your investment, some of the investments that you have made, there may be likely time that you need to review some investments, right? It's a cycle continuing, right? And it is not that one time we set the financial plan, it is going to be forever true, right? It keeps changing, the landscape keeps changing, your assets, your goals keep changing. So you'll have to go through the cycle again and again, right? Okay, so we've introduced another character called Mohan. So this is Mohan. Mohan has a family, and we just try to understand something about Mohan, something about what Mohan, how much he saves, what Mohan does for investing. Let us watch a video which will teach us more about Mohan and our financial plans. So this is Mohan. I'll play the video of Mohan.
Hello friends, I am Mohan Bhargav. Come, let's meet my family. This is my better half, Prerna. She's a consultant. And this is Vidhi. Hey Vidhi, say hi. And that busy man over there is Vivan. I am an engineer by profession. Our household earnings, collectively, is around 1.5 lakh per month. We own a 2.5-year-old car and a motorcycle. Some good memories made there, huh? Our monthly expenses and the kids' school fees amounts up to around 1.1 lakh. Arey haan, how can I forget them? My mama and my papa. They live back in our village. Apart from other expenses, their medicines cost around 10,000 rupees. Feet. Just a second. Thank you. Arey Ashok ji, namaste. How are you? Wait. Guys, this is Ashok ji, my neighbor. Although now he's a retired banker, he's still enjoying life to the fullest. Alright guys, it's time for my Zumba class. Ashok ji, say bye to my followers.
Bye.
Bye. Mohan out.
समझ कर इन्वेस्ट कर
NSE द्वारा निवेशकों के हित में जारी.
Right. So here we understood about Mohan and Mohan's family and their household income and expenses, and about also their neighbor, right? So this is stage one about what Mohan and his family is, right? So let's move forward. I'll go through another video where we'll take the story forward.
Hello, friends. Remember Ashok ji, my banker neighbor? Hi. So today he is going to guide me on how and where to invest the surplus funds that I have. Funds that my wife Prerna and I have. She is recording today's video, huh? Another feather in her crown, huh? Shall we begin, Ashok ji?
Sure, sure. First, I'll show you the 3 sutras which I have followed. Sutra 1, plan for emergencies, family goals, and retirement. Sutra 2, take the impact of inflation into account. Take advantage of the power of compounding. And to get higher returns, you have to take higher risks.
Oh, now I understand.
Oh, wait, Mohan. Don't be so impatient. Now, my third sutra is to invest in products as per your age and risk appetite. Invest in the stock market with a long-term view. Keep monitoring and be patient.
Oh, I should have realized this many years ago. Now I've lost valuable time.
Don't worry, Mohan. The time to start planning for you is now. I will let my friends from National Stock Exchange explain about my sutras in detail and guide you through your investment journey.
That would be awesome. Thank you, Ashok ji.
सोच कर समझ कर इन्वेस्ट कर.
Okay, so moving forward, as you had seen that Ashok was explaining all of his sutras in short, in brief. So let's do one thing. Let's take you through all those sutras in slightly more detail for us to understand. The first and the foremost, what Ashok told was that you need to plan for emergencies, plan for family goals, and plan for retirement. As we had seen in our earlier cycle, that you need to plan first. You need to understand first, what your goals are. So ensure that whenever we are making our family goals, in that your goals also have things like for emergency, for your family, as well as for retirement. Generally, we just tend to forget some of these things. So apart from whatever we wish list that we have of you want to achieve in life, what you want to get in life, ensure that we plan for these parts also: the emergency, your family, as well as for retirement. So as we discussed, it's very important for us to take the impact of inflation into account while we do our planning. And as we saw, as per our financial plan, the financial steps in financial planning, one of the important part was to take likely expenses of our future, how the expenses in future would grow. So if you see over here, suppose there's a college fees. So if you see on the right hand side, there's a screen, there's a chart that shows. So if anyone, if the expenses is about 10 lakh rupees for college fees, and 7 years down the line, somebody needs, your son or your daughter will, end up going in college. So 10 lakhs is a fees today. So we've assumed 6% is inflation. So the cost of 10 lakhs today will become 15.04 lakhs with 6% inflation 7 years down the line. Same way, if you plan to buy a house. So if the value of the house is about 1 crore today, okay, and 10 years down the line, if you plan to buy the house, so 1 crore today, so the same house will cost you 1.79 crores. Okay, that's about 1.8 times more. 10 years down the line. And in terms of family expenses, suppose I assume your family expenses, for example, is 1 lakh today. So if 25 years down the line, somebody who's very young, when he starts going, you're seeing a father spend about 1 lakh rupees with, as family expenses. By the time you grow old, 25 years down the line, when you manage a family, the 1 lakh will become 4.29 lakhs, right? So whenever we are making our calculations to understand how much money will we need in future, right, it is very important for us to understand the 6% assuming as inflation. These are the numbers that we are looking at. So ensure that whenever we are accounting for our expenses in the future, ensure we take this impact of inflation into account. The other part is it's very important for us to take advantage of the power of compounding. Today, everyone's been talking about taking the advantage of power of compounding. So what we've done over here is we've taken it one step ahead, where in both the situations on the left side, you can see a lump sum investment made once and versus a monthly investment which is being made. So in both the accounts, if you see, the power of compounding is taken into account. However, the difference is between paying 1 lakh or investing 1 lakh at one point in time versus in the other way, it is I'm investing 10,000 rupees per month, right? It may be difficult for a lot of people to take out a lump sum amount at once, but it would be easier for people to do a monthly investment. So on the left side, if you see on the graph, we've assumed that on the left side, the blue line that you can see is that a person has invested 1 lakh at one shot. So in after 25 years, at 5% return, your 1 lakh becomes 3.4 lakhs, right? Now, I assume that the markets may give you more return, your investments may give you higher return. So if I assume 7%, it goes to 5.4. If I assume 9%, it goes to 8.6. So my 1 lakh becomes 8.6 lakhs if I give a return of 9%. And if I do 11%, that becomes 13.6 lakhs. So 1 lakh becomes 13.6 lakhs, right? So we have seen the gradual growth. Now, what I want you to do is to compare it with a monthly scheme where it is easier for us to take out money monthly. So if you see, I've taken the same metrics over here. So if somebody starts with 0, so on the left side, we started with 1 lakh because you're investing 1 lakh once. On the right side, we started with 0, which is about 10,000 rupees per month, if you see. So over a 25-year period, at 5% return, on the left side, the lump sum investment, your 1 lakh became 3.4 lakhs. Here, 10,000 rupees per month will take you to 59.6 lakhs. So if you see over here, at a moderate return of 5% itself, a monthly investment of just 10%, which is very easy than coming out with a lump sum investment, you already earn 59.6 lakhs. And if I assume 7%, it goes to 81. And if I assume 9%, it's about 1.12 crores. And at 11%, it becomes 1.58 crores, right? So if you see the difference between the two, the idea is to make people understand that whenever we are investing, a disciplined way of investing every month and not trying to time the market is a very good way of doing it, right? A lot of us understand have heard the term SIP or a systematic investment plan. So a systematic investment plan simply means it's a discipline, it's a habit, it's a way of investing, right? So it's a regular way of investing where we are not trying to time the market, where we're not waiting for things to fall. It is regular, disciplined way of investing, right? That is what we call a systematic investment. So on the right side, if you see, we have taken power of compounding and a systematic investment way of investing. So if you see the returns versus lump sum, right? There's a huge stark difference. So ensure whenever we are investing, the investments always are disciplined way of investing. No matter whatever the amount you're investing, ensure we are disciplined and stay invested for longer term, right? Okay. So moving on ahead, there's something called as a risk reward matrix. So on the y-axis, you can see you have the reward matrix. On top is obviously high reward and below will be your low reward. On the x-axis, we have the low risk on the left side and high risk on the right side. Now, this is where I would like to may make people aware and warn them also, because there are a lot of schemes in the market that you would have seen that promise you very high returns and tell you do not worry, the returns are very good, even more than what generally a bank or a good corporate or a good stock or share will give you. But at the same time, they will tell you there is no risk attached to it. See, we need to understand risk and return go hand in hand, right? There cannot be a scenario where you're actually getting very high reward and there is no risk attached to it. So schemes like this are called unrealistic returns. They promise you maybe assured returns, maybe fixed returns, maybe unrealistic returns. Please ensure you don't fall for any of these things and not in this trap, right? When you're taking high risk, then the rewards can be higher. See, please understand the words that I'm telling. When we are taking higher risk, you can get higher reward. The probability of reward goes on top. That does not guarantee you that rewards will be high. By taking high risk, there are chances that you will get higher reward, right? And what are the products? Then those are derivatives, your futures, some of the equity stocks that are there. Those are your high risk products. And on the other hand, traditionally, we've seen a lot of these all traditional investment products where you have low risk and low returns as well, right? So they are your bank deposits, some saving post office schemes, PPF, and some debt oriented mutual funds. On this scenario, so here you have a scenario where you're taking very high amount of risk, but you're not getting low reward. Then it doesn't make sense, right? Why would anyone take more risk when you're going to get low returns, right? So whenever an offer comes to us to understand as to whether the product is risky or not, what are the returns the product is going to give you, ensure we have this matrix in our mind, right? Generally, we get carried away by the pitch that is made to us, where we get to hear a lot of high rewards that we are going to get, but generally they do not talk about the risks, or they underplay the risks, right? Please ensure that all of us, we are aware of this matrix. The other one is financial products as per your goals. Now, we talked about 3 different types of needs that we have. On the first left side, you can see as short-term goals and emergencies. Then we have medium and long-term goals. And right-hand side, we have your insurance needs, right? So whenever we are investing in products, ensure we invest our products as per our goal. If my goal is short-term goal, or I need to keep money for emergency के लिए पैसे रखने हैं, I don't have to that needs to be liquid, because in an emergency I may or not have the time for the liquidity to come in, right? So I need to invest in products that are highly liquid, right? So which are those products? They will be your savings account, your fixed deposits, your recurring deposits, money market instruments, some mutual funds as well as post office savings schemes. So if you see over here, these generally tend to be very highly liquid and low return kind of investments. Then others one are middle term and long term. So if you understand over here, if you're investing in stocks, ETFs, index funds, mutual funds, PPFs, please understand these are places where there's excess funds that you may not need for the next 3 to 5 years. Only ensure that kind of money has been invested in your stocks and mutual funds, because you need to give them time. And we do not, whatever short-term goals are there, emergency money is there, that we cannot go and buy ahead stocks. Please do not do that. We need to do it as per our goal. And the third goal is the insurance need. Whenever you have an insurance need, obviously you need medical, you need life, you have other insurances as well, right? So we'll not dwell too deep into that, but insurance also is a need, and you have a lot of insurance products in the market as per your need. On the bottom, if you see there's a matrix given over here, wherein on the first circle that you see is the majority is a part of your portfolio. So yellow begins to be a high risk, medium risk is demarcated in blue, and low risk is demarcated in green. So if you see the portfolio on the left side, it is majority of it is high risk, some of it is medium risk, and some of it is low risk. So a person who's young, who's starting his investments, who's very young, can afford to take more risk. However, when you age, when you're close to retirement, post your retirement, it is advisable to take less risk. So if you see your majority of the portfolio is low risk, which is in green color, right? So this is advised. Why this is advised? The simple reason being is because you need to give time for your investments in markets to grow. You need to give it time. And as you age, obviously, in case there are losses, in case you need to take out your money for any other reasons, you will not have sufficient time to give for your money to grow. Correct? So in case there are losses, if the market is down, you need to give it time to grow. Eventually, you will get your returns, right? But you need to give it time. So as you age, you do not have the time to give. But if you're younger, you will have the time to give. So next, what are the investment evaluation factors that you need to take into account? There are multiple factors over here: safety, liquidity, returns, your convenience, your ticket size, taxability, as well as your deductions. So ensure you take these things into account before you invest, right? Suppose, for example, you want to buy physical gold. For physical gold, the ticket size is higher. You want to buy real estate, the ticket size is higher. You want to get into mutual funds, the ticket size is pretty low, right? So ensure we take these things into account whenever we are making our investment decision. So as you saw, Mohan was when he was already married. He had 2 kids when he was actually going to Ashok for advice, right? So Mohan was very late, as we all know. So, but obviously, even if we are late, we should not worry. The earlier you can start, that is the best for you. However, even if you're late, the time for you to start is immediately. If you've not started investing, the best time for you to invest is today. And the next best time for you to invest is tomorrow. The first best time is today. The second best time is tomorrow, right? So ensure you start your investments if you have not started immediately, right? So invest in less risky products when you have a short-term goals, and for your longer-term goals, you may invest in riskier products. And in case your retirement, there's plan for retirement, then invest in the stock markets only for a long-term view. Monitor and keep being patient. Okay, that's the reason we saw Mohan, who was very angry with himself to have lost precious time. Now, this is where I wanted to bring to you at as to why we tell you to invest for a longer time. Now, if you see, these are the returns that we have got in different asset classes over time, right? First, inflation we have assumed at 6.7%. Silver has given you returns of 8%. Fixed deposits, gold has given you roughly 8.5%, 9%. PPF is 9.64%, whereas equity is 15.4%, right? So if you see for longer period of time, if you keep your money invested in equity, so if you see, this is the data for the last 30 years. So in 30 years, as a country, we have seen many things. There are lots of wars that are happening around. We saw COVID. We saw, different political parties come to power, lost power. However, no matter what the situation was, over a period of 30 years, consistently, we have got returns of at an average of 15.4% CAGR, compounded annual growth, right? So CAGR of 15.4% over the last 30-year period, right? And we have seen so many things across in our lives, right? So hence we say if you're invested for a longer time, so no matter what the breaks in the middle are, there will be good moments, there will be bad moments the market has seen. Eventually, over a long period of time, you will get returns which are better than other investment products, right? Having said that, obviously, as we know, diversification is important. So hence, you will not pull out all the money and put it in equity. We will diversify across different asset classes. And our portfolio will be depending on the age that I showed you before. Correct? So remember, investment is not gambling. So you need to put effort for your money to work for you. You are working hard, so money also needs to work hard for you. And you should, when you should know these things, that when you're going, where you're going with your investments, what you're investing in, who you're dealing with, and know where to get help from, right? So people who are new, you need not worry. I will tell you something where we can start. So first, let us understand what is capital markets. So capital markets is basically a place where you and me, individuals and institutions, can buy and sell a variety of asset classes are there, which are stocks, you have bonds, you have futures and options, you have currency, you have commodity. There are a host. It's a basket, right? It's a market where you can go and buy and sell, correct? It's as simple as that. So in Indian capital markets, SEBI is our regulator. So this is where I was coming to at. So I'm introducing, after capital markets, I'm introducing a concept of mutual funds. Now, since this is for people who are getting new into markets, it's very important for us to understand. Now, let us assume that you have a car, okay? You have a car, you know which destination you need to go to, right? But you don't know how to drive, right? We're comparing driving here to investing in capital markets, right? So you have money and you know what your goal is, but you don't know how to invest. Similarly, so what you would do in an analogy where you have a car and you need to go to a destination, but you don't know how to drive. So you call up a driver center, right? And appoint a driver. Okay, I need a driver to take me from X to Y. Correct? Same way, it's very easy for us to understand. Let your mutual funds be your driver, right? You don't know how to invest, or you don't have the time to invest. So we can invest through mutual funds, which is a very good way to start your investing, right? So what does a mutual fund do? They basically pool money of all the investors. There's a fund manager to whom it is assigned to. This fund manager decides on our behalf to invest in different securities and bonds depending on the scheme that you're invested in, and it generates returns. Those returns are then given back to the investors, right? So for people who are new to the markets, it would be a very good option to start with mutual funds first and see how the mutual fund is performing, understand how investments are done, see the returns that you are getting, learn to understand the statements that come to you. You understand to read how to read them. Once you understand these things, then you can invest on your own. Then you probably can open an account yourself and then start investing. This is one way. But people who are already very comfortable, they know they can obviously start investing themselves. This is for people who do not understand how to. And we're concentrating on this since we are talking about Pratham, which is level 1. So why mutual funds? There are various advantages of a mutual fund. It is professionally managed. It is very transparent as to where it is being invested. It is highly liquid. It is very, very convenient to get. It is a very small ticket size. 500,000 bucks is more than enough for you to start investing in an open-ended mutual fund in an SIP fashion. It is obviously very well diversified, well regulated, and absolutely at low cost. So there are huge advantages that a mutual fund offers you, which you can start with. So what happens is there are multiple mutual funds, right? And so when you read through the schemes, you'll understand where it is investing in. So what SEBI has come up with a very good thing is that they have called a riskometer. Okay. Suppose if the text that you're reading is too complicated for you to understand as to what is being told, a very easy way of finding out as to what is your risk in the riskometer, it is very easy for us to understand what is the risk of your investment. So if you're invested in, say, mutual fund X, the mutual fund offer document, the document of a scheme document will have this riskometer where it will provide to you as to what is the risk of your investment. So we have low risk, moderate, high, and very high. Broad 4 categories we have. Depending on what type of investor you are, depending on what type of investment you are looking at, there are different categories that will be given to you, right? Suppose now if you are decided that you need to be in a high or a very high category, to ensure that whatever funds you're putting in high or very high category is kept for a longer tenure, right? Because as I told you, it is cycles. In case the fund value drops, it will need to give it time for it to recover, right? And if you need some mutual funds is a very highly liquid. You need a liquid mutual fund. So your returns, your risk in that will be slightly lower itself, because the returns also will give you slightly lower, right? So depending on what your goal is, what you want to achieve, this is a very easy way of understanding, a very crude method of understanding as to what is the risk level. Okay. So when we are investing in any kind of a mutual fund, it is very important for us to slightly understand about the mutual fund before we go ahead and invest, right? So first, some of these things that you need to understand about before you invest is that you see the performance of the fund. What is the benchmark performance? Your benchmark performance will be your Nifty performance. So what are the returns that Nifty has given you over a period of time versus what is the returns that the fund is giving you? So you will have different funds. Certain funds only give you returns as much as the benchmark does, right? Because they target to give you only that returns that the benchmark gives you, right? So a lot of active funds who try to beat the benchmark, right? So you need to understand that first. Then comes the expense ratio. What is the kind of money you are paying to the mutual fund to do the investments on your behalf? This is very crudely said. It's very crudely said like that, right? Then part is check using the riskometer as to what is the risk level. Then you need to understand the history. What are the performance? What are the returns that the mutual fund has given you for the past 3 to 5 years, right? And then the portfolio turnover ratio. How frequently the fund manager buys or sells securities from the fund. right? How much churning, how much turnover is happening? Is it too frequent for you? You need to check into those things. And then the background and history of the mutual fund manager to understand who the mutual fund manager is, who's managing the money. So that's mutual funds are a very good way to start investing. Now, there are certain investors who feel that, I need some amount of more amount of liquidity. So what happens is when you buy and sell mutual funds, you can do it only at the end of the day prices. Okay, those end of the day prices are called NAV, which is net asset value, right? You cannot do an intraday buying and selling of mutual funds, right? It is bought only at day end prices. It is sold also at day end prices, correct? Now, how about there's a product in the market that is very well diversified? It is diversified like a mutual fund, low ticket size. However, it also gives you the benefits of a share where you can buy and sell like an intraday within the same day. So basically, let's imagine a mutual fund that can be bought and sold like a share, right? Those are called ETFs. Very simply explained. They are supposed to be a very popular choice. One in every 3 people who are investing in stocks do invest in ETFs. It has a lot of benefits. It's low cost, transparent, very flexible, tax efficient as well, and can be traded like a share. So very good, important investment product that we should not miss out on. Another very important product that I would like to introduce is whenever we investment in the form like we call SGBs is very, very beneficial. Now, these are basically government securities which are denominated in grams of gold, right? Here, you pay the issue price in cash, right? And it will be redeemed also in cash on maturity, right? So what is the initial additional benefit that you are getting in a sovereign gold bond versus a traditional investment in gold? Is that here in a sovereign gold bond, you get a 2.5% fixed rate additional returns per annum on the nominal value, which is credited semi-annually. So returns of your gold obviously are there, the gold rate. Apart from the gold rate, you get a 2.5% additional interest as well, right? So investors, you'll earn returns like the prices of gold, correct? It's available obviously in demat and paper form both. So it's a very good product if as long as you want to invest in gold. So here basically the bond is issued by the RBI on behalf of the government. Minimum is 1 gram. So if you go buying physical gold, it is very difficult to buy in small quantities. So here it is available in terms of 1 gram. And the maximum is 4 kg for individuals and 20 kgs for a trust. And it's tradable on our national NSE platform, right? So it's a very good product. One should look out in case you want to invest in golds. Invest in gold. And moving forward, this is my last slide, which I will like to cover. Here, in case you want to learn more about what securities market is, so I have given you 3 options are provided over here. You can go to these 3 options. So, in fact, if I come to the left side, SEBI has recently updated its investor education website. So there are lots of financial calculators, whatever graphs and charts I had shown you. So if you have a goal, you can go to those financial calculators, provide your goals, provide your options, provide the interest that you think you will get, and it will give you the SIP amount. It will give you the inflation figures. So there are multiple things that you can play with using a financial calculator. So you don't have to manually sit down and calculate everything. So you have a lot of financial calculators. That is one. Secondly, you want to learn more about investing. Definitely, that's another tool that you can use. SEBI also has that app, which is called the Sarthi app, right? So there are a lot of questions that you can get answered for using this app. We also have our website called nseindia.com, right? Here also there's a lot of material for you available. So what I like to add one part over here is that we do a lot of these investor awareness sessions throughout the year, right? So now we're doing level 1. So if you go to our website called nseindia.com, there you will find there's a whole host of programs that we are doing level wise. A lot of them are, open for public, and you can do through webinar. A lot of them are also on-ground seminars. So you'll get the entire calendar on my website. You can go ahead in case you feel anytime like joining. They're all free of cost. You don't have to separately, just register and join. So if whatever time you have, 15 minutes, 20 minutes, whatever time you can devote and give, you can go ahead and attend any of the sessions. And if you missed out, obviously you have other sessions to catch up on. So please, if in case you want to learn more about it, these are the good tools that are available with you. And please don't take learnings from a lot of social media, unauthorized websites that you see. Ensure that it is authorized. You're dealing with only authorized people who are registered with SEBI, and the source where you are learning from, ensure that source is authenticated. Some samples I have given in front of us, right? So with this, I'll end my presentation. And in case you have any questions, I'm free. We can take up any of these questions.
Thank you, Gaurav. Thank you so much for enlightening us on investment awareness. And the story of Mohan was quite interesting. Thank you. So I think we can move to a Q&A session. We have lots of questions coming. I think we can start. So there's one question. What is emergency fund size? Why is it important in your financial plan?
Okay. As I told you that, whenever in our investment sutras, one of the sutra had, investment emergency, plan for emergency. I'm glad somebody was actually paying a lot of attention to emergency. So what happens is like, generally it is said, depending on your job, okay, generally it is 3 to 6 months of your monthly income is what you would save as an emergency fund. Suppose if you have a stable job, 3 to 6 months would suffice. And if the job is not very stable, or if it's a business and it's not too stable, you're still finding your feet, months also you can extend, right? 6 months or 9 months or 3 months, depending on the job security. That is one. The other part is whenever we are investing this particular fund, ensure that it is being invested in products that are liquid, because you will need them at within a few hours itself, maybe at some time, right? To ensure the product that you're investing in is also highly liquid.
Okay. Thank you. So the next question we have, how can I track the performance of my mutual funds?
Okay, great. So during the presentation itself, we covered a particular slide where we where I did cover what are the points that you need to take care. That so what happens is I'll just reiterate a couple of which are very important points as to see what the returns that the benchmark index has given you. Then also compare the fund that you are that you're investing in. What returns has the fund given you compared to what the benchmark has given you? See what the expense ratio is, because that's a very important factor. I'll tell you why. Because what happens is whenever the funds that are just tracking the index, right, where they aim to give returns as much as the index. So the mutual fund manager does not have to strive very hard to find stocks, right? So there it can be as low as 0.2%. Whereas in some of the active funds, it can go as high as 1%, right? So you need to take that part also into consideration. The other one is returns that what the mutual fund has given you, not over a short time, but over a 3 to 5 year period. Then understand who's a mutual fund manager, this history, their returns that the manager is able to generate over a period of time. So see some of the few important things that you need to take care and understand how your fund is performing.
So the next question is also my personal question, which we have received a lot. Are there any minimum investment required for mutual funds?
500,000 rupees is more than enough for you to start a open-ended mutual fund. As I told you, it has to be as much as systematic investment planning is the best way to move forward with it. It's easier for us to save 500,000 bucks a month rather than for me saving 10-20,000 immediately, right? So as low as 500,000 rupees you start, you can have an SIP. Monthly it keeps deducting from your account. There's no better way to start.
So also there's a question, can NRIs invest in SGB?
That is for individuals, trusts, as well as there was one more entity, but not for NRIs. HUF, right?
Okay. The next one is, can I redeem SGB bonds before maturity?
I'm sorry, I lost you. I think there's a internet connectivity or a lag.
Am I audible, Gaurav?
Yeah, now you are. Please, can
Okay.
you continue your
So the
question?
question is, can I redeem SGB bonds before maturity?
Yes, SGB is basically whenever you invest in SGBs, you are in it for the longer run. That's the primary objective. So for the first 5 years, definitely there's lock-in. However, in case you want to sell, you can do it on the exchange platform. After 5 years, you have the option of redeeming. So as long as you have a trading account, it's easier. And however, after 5 years, you can do an early redemption.
There's one more question, like how do ETF differ from mutual funds?
Okay, I think I covered that during our presentation. Presentation is that, see, what happens in a mutual fund is very diversified. However, it has a disadvantage of that it can be only bought and sold only at the end of the day prices. But when it comes to ETFs, so you get the advantage of a mutual fund, but it can also be bought and sold like a share, which is another advantage. You can do an intraday. On the same day, you can buy and sell that, right? So ETFs have that upper hand in terms of if you want to have more flexibility in buying and selling.
So there's one more question related to ETF. Can I trade ETF throughout the day like an individual stocks?
I think we covered that. Yes, you can.
I think there's too many questions. The last one is, what is the expense ratio of an ETF?
Okay. So what happens is that in an expense ratio, what happens is that you're paying a mutual fund. There's a mutual fund manager who manages on your behalf, right? So there are certain expenses that is unki salary unko deni hai. Whatever, wherever they're sitting, that the premises, the certain small expenses are there. So what happens is, if you appoint a manager on your own, right, the expenses are going to be very, very high, right? At same point in time, when it's a mutual fund, so we have thousands and thousands of people who together pool together and pay the administrative expenses. So that's where I told you it can be as low as 0.2% of your investments, right? So where I'm learning, and if I don't have the time, I don't mind giving 0.2%, right? So that's a charge you pay for somebody managing your fund.
So great. I think we have covered lots of questions. Thank you so much, Gaurav, for your time, and it was very interesting webinar. Lots of information, insights. Thank you so much. I think we can end this. Thank you.
Okay. Thank you, everyone. So hope we'll meet for another session on the next level 2 of our program.
Yeah. Thank you. Thank you all.
Thank you, everyone.